Welcome Manishi Raychaudhuri in our studio, and it's nice to have you in Mumbai. What brings you in Mumbai? On the way to Kumbh, or you came for marathon or Coldplay?
Well, not
You know,
quite.
I met a bunch of parents in the morning, and all the conversations were centered around who's going to Coldplay, who ran the marathon, and who's going to Kumbh.
Right. So you know where the focus is right now, right?
Nobody's talking Trump, nobody's talking markets, trust me. So what brings you to Mumbai?
Well, I have a few clients. As you know, I've started my own business, my own
Congratulations,
financial
good luck,
advisory company. So I have a few clients here, and I'm trying to meet with quite a few of the senior buy-side people. And because many of the institutional investors in India, they're actually looking at East Asia in terms of trying to raise additional capital. And I'm looking at helping them do that.
No, I'm sure it'll be a great venture, and good luck. You've got lots and lots of experience. I've interacted with you, over 25 years now?
Yeah, I mean, I did
Warburg days,
across
UBS
three,
days, UBS days.
those
UBS
right,
days.
exactly.
Yes, those were like
the company was called Warburg Dillon
Yes.
Reed those days, remember? Yeah.
Such days, Sensex was 5,000.
Right.
Wow.
Can you imagine?
I mean, I've seen Sensex at 2,600 also, 2,500, 600, in 1996.
No,
Yeah.
I'm slightly young for that.
Yeah, but in hindsight, one just thinks that an index ETF is all that you needed.
Yeah.
Right?
Yeah. I was just reading, I think, Warren Buffett's comment that the average US investor is better off investing in a S&P 500 ETF,
Yeah.
which is exactly the similar.
They say that if you're long-term bull, ETF is the best and the cheapest way to go.
Yeah.
Simple. Just keep it very, very, very
Right.
simple. No listen to anybody. Just keep it very simple. Okay. But your clients would say, okay, we know that already.
Right.
Tell us what we don't know. So what are you telling your clients, your prospective clients, that what they don't know in terms of the market links, connections, and valuations?
Well, in the near term, I'm perhaps telling them not to invest in India, not even in the ETFs. In case, you're looking for a parking space for your money, gold is a good alternative. Gold ETFs are what I'm doing personally.
Okay.
Yeah. So, I'll elaborate on all these
Why
themes.
gold? It's already...
No. First, why not India?
Why not India?
Yeah.
Two things. Number one, look at how, and this is possibly the most important variable that we all need to look at, the consensus earnings estimates. I actually pay relatively less attention to this whole topic and discussion of GDP growth, etc.
Sure.
It's a good, it's a good talking point, but it doesn't really generate returns. If you look at consensus EPS estimates for India, any index that you look at, they're down about 7% from late September. The market is down 10%, but it means that the valuations haven't really corrected all that much. They remain almost as expensive as they used to be in mid to late September. When you look at the relative valuations, India in relation to Asia ex Japan, that argument becomes even more egregious. India is on a forward P basis trading at about 62% premium to Asia ex Japan. The long-term average is 38%. On price to book, it's between 80 to 90% premium. The long-term average is 60%. These premia, they need to correct. It can happen in two ways: India correcting or rest of Asia moving up. I think as of now, the latter is happening. Just look at how Hong Kong behaved recently, how Korea has done. Korea is up about 5 to 6% this year. I think investors are beginning to understand that there are cheaper alternatives which give them similar growth profile, similar earnings growth profile in the medium term, but available at far lower valuations.
Okay. Can you compare historical averages to predict future? Because the reason why they got historical averages is because interest rates were different, dynamics were different, political policy were different. When we say, okay, China, India is trading at a premium to China.
Right.
But I would say that China is a different beast. How can we compare these two things?
Right. You see, one of the reasons and the way to look at it is what kind of, ultimately, a stock price is the cash flows discounted to the present value.
Yes.
Right. Now, if you believe that there's a certain stock in this universe which is likely to generate a certain stream of cash flows going forward in the foreseeable time horizon, then it makes sense to compare, similar stocks across time periods. So now when you compare Indian consumption, let's say the consumer staples like levers, or more egregious are the paints companies, like Asian Paints, etc., and compare them to some of the consumers or consumer proxies in China, yes, the growth rate for these cash flows would be a lot lower in China. But even accounting for that, the valuations are not really comparable. Valuations are, possibly egregiously high in India. And that is what worries me. And in the particular context of earnings estimates coming down, it's even more worrisome, because then what is expensive today would appear more expensive tomorrow.
So other than, staples and some of the consumption players like in Asian, which of course is a unique story because of the competition in this space, where is it that you feel that, the valuations have run up far ahead and people were pricing in, multiples even 2 year forward, where you don't think that kind of earnings growth is actually going to come in?
Many of the public sector companies, the defense-related companies, many of these, the manufacturing darlings, I would say. So to a large extent, industrials, manufacturing, consumer staples, which is a significant part of the market, would fall into that bracket.
But Manishi, we were just flagging for our viewers as well that IT as a space you're still bullish on, and we were just hearing out and the commentaries. It's kind of a mixed bag. Even some of the companies which have come out with the decent earnings, guidance upgrade, they are not finding investor interest right now. So what's your take on the IT?
IT, unlike many of the sectors that investors are focused on today, which are essentially domestic focused sectors, IT sector in India generally gets its revenue from the developed markets, and that's United States pretty much. We are living in an age of US exceptionalism, where the growth rates in the United States, we all thought US would be drifting into a recession. Didn't happen. No one really talks about that anymore. It looks like US would still continue growing at about 2 to 2.5%, and especially the banks, they have reported not only good numbers, they're likely to report similar numbers because the bond yields are high, interest rates likely to remain elevated, which means that their interest margins would possibly be supported. Those companies are the biggest contributors to the revenues of the IT companies. So yes, today it's not really the kind of the topic du jour. So it's not getting investor interest at this point of time. It would need a few more sets of numbers to come through, a few more articulation of guidance on the part of these companies before that interest builds up.
But, it's been a long winter, right? TCS is not ready to commit a double-digit growth.
Right.
Infosys numbers do not add up the formal number that there is a double-digit growth coming anytime soon. Wipro is still a sleepy company in terms of what they can achieve. So my point is that it's been about 3-4 quarters that the turn was supposed to happen, and for next 2 quarters I don't see the turn happening. So at a time when markets are searching for growth, they're hungry for growth, why would they go towards IT, which are anemic when it comes to growth?
You see, I don't necessarily agree with you that over the next 2 quarters that growth articulation won't come through. I personally believe that...
With all the Donald Trump, all the rhetoric on H-1B visa, the terrain could get tough rather than easy.
See, this whole Trump administration and that MAGA team, that's also divided across the spectrum. On one hand, you have the techies, you have Elon Musk, and you have the others who actually want to import good quality, high quality manpower. On the other side, you have the Laura Loomers of the world who are pathologically opposed to all H-1B, right? I think as of now, going by the kind of news flow, the kind of imagery that we are seeing from the Trump administration and particularly the inauguration, it is clear that the big tech clearly has more leverage on the Trump administration. After all, they are, they're the money bags. They have the money, right? So I would not be too bearish on the negative news flow that we're hearing on the H-1Bs, because there is, in a large alliance like this, you will have these diverse opinions on different parts.
Well, Manish, Trump taking the power, what could be the likely impact on the global markets? Because just yesterday after the inauguration, we have seen a lot of these comments coming up. There was a reaction in the crude oil prices that the energy transition could be where the US could be leading from the front. Other than that, there's some announcements on the EV. So where do you feel that the focus will be on?
Right. So, one area where, the Trump administration's policies would be drastically different from the Biden-Harris administration would be what you just mentioned, the energy policy, which possibly means that many of these climate agreements, the net zero targets, they could get pushed back, not officially. I mean, I don't think India would articulate that, okay, I'm pushing back my net zero target from 2070, neither would China. But at the same time, it would mean that production of crude and possibly demand for crude would be on a slightly higher keel than we have seen earlier. On the other hand, the incoming Trump administration, they have clearly articulated that tariffs are, they're coming, not just on China, but also on the other trading partners. He talked about 25% tariffs on Canada and Mexico. Could be a negotiating tactic, no doubt. I've seen that in the Trump 1 administration also. But it means that while in Trump 1 administration it took about 1.5 years to articulate these policies, now it'll happen right off the bat. Now, there's one important difference between Trump 1 and Trump 2, and that's inflation. Today, we're living in a much higher inflationary environment and a much higher inflationary outlook going forward, which is reflected in that discussion that we are hearing over the last 1 week, that the tariffs would be imposed in a phased manner, 2 to 5% every month, which means that the policymakers are actually conscious of, what's hitting them. So, it's kind of going to be a mixed bag, but over the next 1 quarter at least, you will constantly hear these, various different news flows. So it is going to be volatile. Grab your seats and, just brace for uncertainty.
Oh, yeah, absolutely. We'll do just that. But Manishi, great to have you in the studios. Thank you so much for your time and have a good India's Day.
My pleasure.
If you like this video, then like, share and subscribe to ET Now.